Just give me a minute, folks. We got just waiting for Nancy to join in and come on board. So just give me 30 seconds or a little bit of time, and we'll get going. Hey, George. Hey, Aaron. Hey, Nancy. How are you?
I'm great. Good morning. How are you?
I'm doing well, thanks. Doing well. Did you have a nice little extended weekend?
Yeah. How about
Yeah,
you?
yeah, not bad. Yeah, just kind of hung out with the family, and the kids started camp yesterday, so we had they were off from like 7:30 to 5. It was quite a shift for us. We're normally only like 9 to 1 in preschool, so it was it was pretty quiet around the house yesterday, Nancy, and today.
That's awesome.
Yeah. But thanks again for joining us and kind of sharing your time on this on this Tuesday morning here at the end of June. We got lots going on, and I know you've been kind enough to pop on to a couple of our kind of Wednesday night sessions or weekly notebook reviews, and but I think tonight, or today, excuse me, the plan was just kind of get a little bit deeper into sort of some of your thoughts in your specific field, aka kind of fixed income and how you kind of leverage derivatives and stuff like that to help hedge against inflation and interest rate risk and that kind of thing. So some folks probably or many likely know your background, Nancy, but I'd love to just sort of spend a few minutes on sort of what drove the formation of Quadratic and sort of what I know you guys went the ETF route, which is obviously a little bit different than most fund managers and that kind of stuff would have with your background, especially specifically may have gone a bit more the hedge fund route, but just kind of curious or would love for the group to expand a little bit more on kind of Quadratic and the background there and the formation of the firm.
Yeah, definitely. I'd be happy to talk about it. I spent about a decade at Goldman Sachs, where I was mostly on the prop desk. In 2003, I got promoted to be the head of credit derivatives and OTC trading for the prop team. I ran the group for about 5 years, and then I got recruited out by JP Morgan's hedge fund, which was the biggest hedge fund in the world globally at the time. It doesn't even exist anymore, at least the public side. It's only private now. And then I actually was a stay-at-home mom for 3.5 years when my kids were little, which was a great thing to really invest in them. And then when my youngest started kindergarten, I came back to my career thinking, I'm a bit of a workaholic. So I would go to the buy side instead of, a hedge fund. And I joined Alliance Bernstein. And I love to say that it helped me really get all my entrepreneurial bones going because I was like, oh my gosh, I don't want to work at a big company. I don't want to be in meetings all the time, meetings to have meetings.
Yeah,
It was like
have a meeting
everything
to
that I,
have, yeah, exactly, have a meeting to just get to, yes, we can do this.
yeah, it was, I mean, it was great in a way because I, basically reported to like, senior leadership after being a
Sure.
soccer mom for 3.5 years for a 9,000 person company owned by a French insurance company. So it was a great opportunity, but it also was like sort of that moment where I was like, it's a couple years later, but everything still applies and the opportunity set is really great. And I'm just going to go for it. And I started my firm in 2013. And, it was really, really exciting. Like I feel like I've gotten a lot of other people to kind of go down the entrepreneurial path because I've loved it. It's been such an adventure. Building a culture, building a firm. I even on my iPhone, the background of my phone is not my children. It's actually my first office for Quadratic because I got a little bronze sign made. I had the landlord tack it on the side of the building. I bought some used office furniture, hired some people. Like it was really just
That's that's so
invigorating.
cool. That's amazing. That's awesome, Nancy. No, that's what it's all about right there. And I think, you have a lot of similar like-minded folks listening in today, and just sort of either they're driving their own small business or working inside of their own little, family office, or whatever they might do, right? That's really cool to hear. And I know so again, I mean, you originally launched IVOL, is that correct? And then kind of
Yeah,
later
no,
on did BNDD. Is that accurate?
yeah, before we launched either ETF, we were a long convexity private fund.
Okay.
And so we did that for, the firm started in 2013 and I've all listed in 2019. So for that period in between, we were managing pools, private, same like commingled funds, but privately, not publicly. And I
Yep.
think I just had the, kind of eureka moment that having private funds was, you know, just, a little bit uh antiquated, I would say. Like to put in a subscription agreement, you have to send, all of your passport, who you are. Like all the investors had to like fax stuff to the Cayman Islands, and then you can only buy or sell, essentially the fund on a monthly basis. And
Hmm.
that was a good liquidity. And we invest in some of the biggest markets in the world, being the fixed income markets. And so I just thought, I was like, this is such a better package for our investors, to still give them the active management, but to have, no liquidity lockups, lower fees, no incentive fee. And so we decided to convert the firm to an ETF, which was, probably a little like, it was out there. I definitely had friends being like, what the heck? What are you doing?
Yeah, yeah,
That's,
yeah.
are you sure about that? Like,
Hey, do
so
you know what you're getting into?
I
Yeah,
know,
exactly.
right? Like, so we were, the first of our kind ETF there, as far as I'm aware, had never been an ETF to access the OTC interest rate options markets before us. There are some others now that have opened up the market, but it's one of the biggest markets in the world. And I think a lot of the ETF community is very focused on slicing and dicing the corporate side of the markets. So whether that's like corporate equities or corporate bonds, be it investment grade, levered loans, high yield, fixed income, but it's all corporate stuff. And then there are
Mhm,
treasury ETFs. But I was just like, this is going to be really great. And I think the thing that we try to really educate people on is that most people are short fixed income volatility, especially
mhm.
since after the financial crisis, many of the passive indices are fixed income are market cap weighted. And that's really
Yep.
important because it doesn't make a ton of sense when essentially a market cap weighted index is yields, generally have gone, with the exception of right now, gone
Yeah.
down since the financial crisis. The weighting towards, governments and long duration assets has gone up. So about a third of the ag index, which is kind of the benchmark core fixed income index for most institutional investors, at least, core fixed income doesn't have any inflation protection in that index. There's none. So and also a third of it is only short fixed income volatility because of the allocation to mortgages. And very
Hmm.
like super simple example is, mortgage, the homeowner is long the option to prepay. You can prepay
Hmm.
your loan anytime you want. In Canada, it's not the case. You have penalties, so Canada is
Hmm.
not the same as here. But in the US, you can prepay. And so the owner of the financial mortgage is actually, if you think about your short optionality to homeowners.
Hmm.
So we're trying to, that's sometimes called negative convexity or prepayment risk. It's just a nice word for being short volatility. And so these strategies are both long volatility, which we thought was important to give investors access to, so they're not only short fixed income vol in their bond portfolio.
Yeah, exactly, right. And I'm sure many didn't even know that they were, right? So you've mentioned kind of just along the lines of kind of options and the derivatives, right, that you leverage inside the fund. In particular, you mentioned on our calls like the swaptions that you sometimes use or that you certainly keep track of. So I've kind of two questions there. One is, you have mentioned before kind of the best way to track those, but and then the second part of that question is, how does like the movement in the swaptions market or just the derivatives market in general influence some of your decision making, right? So influence kind of how you're positioning the fund or what kind of options you're looking to leverage on top of to kind of execute the way that you are seeing the market kind of shifting, whether it's with the yield curve at 0.08% on the tens and twos, right? Or they were for a minute inverted there in April. I got close last week, but I didn't quite hit it. So again, just kind of curious as to like what you're seeing in terms of the interest rate market in general, I guess, or like the fixed income market in general, and then how are you using some of those option strategies and derivatives to execute that longer term thought process?
Yeah, definitely. This is a little bit, I don't want to get too like technical or jargony, but we actually don't use
I
swaptions.
see. Don't use options. Okay, so I was
They're not
mistaken. Okay,
swaptions.
okay,
They're just generally in the US interest rate markets. There are kind of four main types of options. There's
okay,
treasury options, which is a listed product on treasuries, which is what like an index like the move index is going to look at the listed treasury market because the index world needs to consume prices, so it has to have a listed instrument. So that's bond volatility from treasuries, but a lot of the institutional market doesn't trade treasuries because they don't want to pay for it, right? They don't want to fund it, so they use a swaps market, which is approximately 5 times bigger than the equity market. It's a huge market. If you think about it, every global bond issuer in the world, whether it's a sovereign or corporate, it could be international corporates, global sovereigns, when they issue bonds in dollars, they hedge their rate exposure in swaps. So it's a very big market. And then on the swaps market, you have swaptions, which are options on swaps. That's not what we use inside of our strategies. It's
okay.
um,
I
something
apologize. I
different.
apologize if I
Yeah.
misheard in the past. I
No,
apologize for that. Yeah.
it's it's like a technical, but just being an accurate person, I want to
No, no, it
explain.
must. Yeah, no, no, that's perfect. Thank you.
And then there's the Eurodollar option market, which is listed, a listed market, which some people use to, it used to be a lot bigger and more active and you could trade out longer dated, but right now there's not a lot of liquidity in that because of the SOFR LIBOR transition that happened January 1, 2020. And so it really just trades in the front dated. So I don't personally think that's the best these days. And then there's the options that we use, which are just interest rate options, but they're options that are on the spread between short and long dated rates. So it's a spread product option. They're not swaptions, they're options, just regular interest rate options. There's, but That's a little technical, but there's a lot of different types of even US dollar interest rates. So it's important. I think a lot of times people will talk about the yield curve, but they're talking about the spot yield curve. And I think the one thing I want to, emphasize to investors is the spot curve is not necessarily the best thing to look at because all markets are forward looking. So just like, nobody would look at when you look at the oil market, for instance, you're always looking at is a curve in backwardation and contango because you're not trading spot oil, you're trading oil in the future. With the futures market, the rates market doesn't have a futures market because it's not listed. It's not a listed market, but it has a forward market, which is the same concept. It's just a different jargon term. And so the spot market is I can just read you levels from my Bloomberg screen. The twos tens treasury curve, which is what most people can easily see, is about 8 basis points positive. But the swaps curve, which is, I would say, a larger, bigger market because it's more global, is actually negative right now. It's negative 26 basis points, so below zero. So what that means is, an investor would get paid more yield to own 2-year paper than 10-year paper. That's not a typically considered normal or healthy sign. But the forward curve is actually even more negative because that prices in all the rate hikes. So right now, in Fed Fund futures, I see 189 basis points priced in through 2022. So think about it; it's less than 5.5 months, less than 5.5 months. The Fed needs to hike 189 basis points additional. That's an additional to the 150 they've already hiked to just meet expectations. So the forward curve, because it has those hikes, is actually even more negative. So a lot of people look at the yield curve as a precursor to, like, is it chicken or egg? Does it cause a recession, or is it a, indicator of a recession? But the rates market is definitely priced for, kind of not, very credible Fed in terms of the Fed hiking rates. The market believes the Fed is going to hike rates. I personally think that could be a good fade opportunity because I don't see them hiking another 190 basis points in the next 5+ months. I think they'll probably hike another 75, maybe another 50, but I think almost 200 is a little high. But people can have their own view, and these strategies are trying to solve for, the short convexity inside of bond funds and give investors, hopefully, at least for IVOL, because it's been around, 3 years. Historically, it's been very non-correlated to most common asset classes because it
Yeah.
doesn't look like everything else.
Yeah. And a lot of that, and so again, if anyone's looking for those correlations and those tables, I was I was pulling it up this morning, Nancy, and you guys do a great job of putting that out on the Quadratic, Capital website. So I believe it's just IVOLETF.com is for the IVOL. You can get the presentation, stuff like that, for those out there. So same thing for the BNDD one. So definitely take a look at those. But so with the kind of forward curve looking the way it does, and the current yield curve being negative. So what kind of credit risk are you sort of trying to mitigate against, or what are you kind of seeing out there that is giving you a bit of pause, or that you're kind of, again, trying to perhaps use some derivative strategies to mitigate against that type of risk right now?
Yeah. So before I have to say I'm not a financial advisor, so I'm not
Yeah.
none of this is investment advice.
Yeah,
I'm just,
yeah, good
I'm
call.
the portfolio
I should have
manager.
started with that, Nancy. I should have started that. Yeah, no,
No
this is
worries.
for
I just
educational purposes only.
Yeah, not financial advice. It's just and I'm not a financial advisor. I'm just the portfolio manager for these two funds. But I think generally I would say a lot of investors, when they really, it's a great time to kind of rethink that traditional 60/40 portfolio. And I did post an article over the weekend, that I was trying to, like, alert investors to just be cautious of that, because a lot of it is based on these market cap weighted fixed income indices, and they're not very diversified, in my opinion, because they do not have inflation protection. They tend to only be short fixed income volatility, and they take a lot of credit spread risk. There's generally only two types of bond risks. You can kind of, just to oversimplify it, there's rate risk, which a lot of people are very focused on. That's when, fixed income funds or investors or strategies talk about their duration risk. That's a rate risk. But one thing that I think doesn't get a lot of attention is the credit risk. And so, if you have, for instance, a short duration fixed income strategy, and it's not all governments, it has other stuff in there, it probably is taking a lot of credit spread risk, because there's only two types of risk. So if you don't take a lot of rate risk, you have to add, you either get government returns, or you take a lot of credit spread risk for a lot of these strategies. And a lot of them tend to have a lot of structured credit inside of them. So it's not saying one strategy is better than others. I just think it's an important time for investors to be really rethinking that traditional 60/40 portfolio, because if we had a stagflationary environment, which, just to define that, that would be higher prices and lower growth, that could potentially make both bonds and stocks sell off together, which is what we've seen, so far in 2022.
That's awesome. It makes perfect sense, and I know you've actually mentioned sort of that in conversation before, just in terms of like the short duration or just the credit spread risk in general and how it can definitely sneak up on folks. Um, X2, let me bring you up to speak. I know you had a question for Nancy, maybe around some uh, uh, perhaps some FX if you can, and then I'm going to open it up to the floor as well. So we're going to start with kind of X2 here, if he can join, jump on. But otherwise, we'll kind of open it up. So for anybody who's listening in who wants to ask Nancy a couple questions, I'll by all means come up and speak or raise your hand, shoot me a note, what have you. Uh, I don't know if he can come join, but Nancy, his question was around basically if you had any thoughts or plans in terms of maybe a currency vol product in the future, and whether or not that's something that's doable, or if that's sort of kind of outside of your that kind of purview type thing.
We don't have any plans right now to do
Okay.
a currency ETF. Right now, it's actually you're not allowed to talk about ETFs before you actually file for them because they are
Okay.
public funds. So there's definitely no plans until there's a filing. You can't really talk about it at all.
Sure.
Because they are all public. It's just a compliance thing. So just to be careful. But I can say, Quadratic, prior to doing ETFs, did invest across all five asset classes. So
Okay.
all with convexity, all with there's generally derivatives, can be thought of like fruit. There's a
Yep.
lot of different types of derivative products. I personally am not a fan of linear derivatives. So these are, the most commonly traded are derivatives that go up a dollar and down a dollar. So that would be, futures. You make a dollar, lose a dollar. Swaps make a dollar, lose a dollar. Forwards make a dollar, lose a dollar. Those are all linear derivatives, meaning sometimes they're called delta one, meaning they have a one delta. Options are what I really enjoy quite a bit and think it's just a different way, in my opinion, to risk manage. Selling options is pretty common in equities because people want to collect the time decay. I'm not, that's not what we do at my firm. There are a lot of places that will sell options and do these overriding strategies. I personally, don't like those. To me, I'd rather structure it with positive convexity. So we focus on long only options, which is why I thought it made a lot of sense to put it into an ETF because it is long only and to price it that way
Hmm.
instead of charging an incentive fee. And that, with that, you have, asymmetric potential upside, but the downside is limited to the market value of the options. So I think it's a different way to structure risk. I see it as, stop lossing when you enter into a position because there's never a funding obligation above and beyond what you pay for it. And the problem with a lot of linear derivatives, whether they're in ETFs or mutual funds or hedge funds, whatever, it's always linear derivatives that blow up because there's funding risk, right? Have to meet margin calls or you have to meet counterparty margin calls or exchange margin calls because you're essentially using, um, financial leverage. It's like a credit card with a linear derivative where you pay a little bit to get lots of exposure. Options, fully funded options have, I'd say, they have the asymmetry, but you're not borrowing money and there's not a funding obligation. So to me, we really specialize in long only option strategies, which is it's a little unusual. It's definitely a different methodology than most strategies which tend to use linear derivatives. Like a lot of I think it's surprising to people how much linear derivatives are used in fixed income ETFs. They're every place you see there's, futures, forward swaps. There's lots of linear derivatives in fixed income ETFs. And to me, I think investors just need to be aware of what's out there. Not all ETFs use derivatives, but a lot of especially people who own a lot of short duration strategies, especially in mutual fund format, and a lot of these strategies have tons of, whether it's CMBX or ABS or futures or forwards or swaps. It's just important. Derivatives have a bad reputation, I would say, for a good reason generally.
Yeah.
You just have to be careful, and just be careful you understand and know what you own, and it's important to read the prospectuses of all strategies that you invest in and really get under the hood and get what the strategy is doing now, and also what it's capable of doing in the future.
Yeah, makes perfect sense. And so if we pivot maybe just a little bit, just along kind of like the inflation deflation side of the puzzle, a lot of folks, and I know I was listening in on one where they were talking more about the hard assets, right, in terms of in terms of owning gold and things like that on the spaces that you were on, Nancy. But I'd love to kind of just hear, like, kind of understand a bit more about sort of how you think about the deflation like hedge or piece of the puzzle, and what that kind of means inside of either IVOL or BNDD, and kind of the way that it's currently kind of set up.
Yeah, no, I think generally they're both very big risks
Right.
to investors. They're not opposite. The words kind of sound similar, but it's not if you don't have, there's definitely a lot of middle ground between the
Uh,
two. um,
yeah, I completely agree. Yeah, it's kind of a lot of gray zone, right?
Yeah, yeah, the words sound similar, but they're really, really quite different. So I think, to me, inflation is one of these things that I think most people should have in their portfolio, in my opinion. Again, not financial advice, but in just very simply, I think, we live in a real world. Especially the closer you get to retirement, you tend to have more fixed income securities in your asset allocation than equities. And most fixed income passive indices, like the ag, for instance, doesn't have any inflation protection in it. So I think it's pretty important to be, since we live in a real world and there are real cost of livings, especially like if you think about if you're retired, you're not going to benefit from wage inflation. You're just going to have higher costs to live. So I personally think inflation is something that people really should not be taking a bet about whether it's going to stick around or it's not going to stick around, because it's a risk to to portfolios. Inflation generally devalues debts and drives, it's just a real concern. And I think deflation is also a risk, especially for levered balance sheets. Just look at Japan. There's a lot of leverage. It continues to exist. There's a lot going on right now in the Japanese markets with the Bank of Japan's yield curve control. But I think deflation is also a big risk for investors. So we, are not trying to, we're not macro pundits. We're not predicting the future. We're just giving investors tools so they can kind of, maybe a good analogy is they're like Lego blocks, and you can build whatever castle you want. You have liquidity, you have transparency, and depending on what your view is, and also how your portfolio is positioned. It's funny, sometimes some of the biggest deflationists out there, they'll have their whole portfolio structured for deflation. They'll still own something like IVOL, because you don't want to have everything in your portfolio, be positioned the same way. So some people, are big deflationists, but say, look, just in case I'm wrong, I'm going to be losing all over the place in the rest of the portfolio. I'm going to put some eyeball in just in case,
Yeah,
So
no, 100%, 100%. So again, I'm happy to open it up. I mean, I've asked a number of my questions that I had for Nancy, are kind of the things that I sort of wanted to talk about. So we can either wrap this up in half an hour, Nancy, or we'll open it up to the floor. I guess as we kind of wait for anybody to come up to speak. But is there anything on that you're seeing out there that you really kind of think the general public should sort of be conscientious about, or be aware of, as they're either positioning for fixed income in their portfolios, or just thinking about just again just kind of general market conditions in general.
yeah, I would say I'd be, aware of what you have inside strategies. Just don't go on name only. You actually have to look inside and see what the strategies are investing in, the the nice thing about mutual funds and ETFs is generally they're transparent, so you can see all the portfolio holdings and really get a good sense of what the strategies are doing. I think mortgages in particular are particularly, obviously, you know, mortgage yield or the interest rates on mortgages have shot up quite a bit. But I think especially with the QT just starting, it's and the Fed kind of being transparent that they don't plan to hold mortgages on their balance sheet long term. I did post a tweet with the Soma holdings, which is what the
Hmm.
Fed bought in open market purchases. So that's likely what they're going to be allowing to unwind or sell, the Soma portfolios, that part
Hmm.
of their balance sheet. So I would just say be careful with fixed income right now because it's it's a it's definitely an unknown territory with the Fed, doing QT and being aggressive with tightening monetary policy. And I'd say the one thing also I would add is that even though realized inflation is at 40-year high, is probably the highest it's ever been in any of our lifetimes, future inflation expectations are not anywhere near realized inflation, and that's because there's a lot of credibility with the Fed that hiking policy rates are going to slow inflation. And you can see that the break even curve is dramatically downward sloping. You can look at various interest rate levels to see that as well. But I think it's all about all markets are forward looking, right? They equity markets forward looking, bond markets forward looking, rates markets forward looking, inflation markets are also forward looking. And so it's not what's happening now, it's what's priced in the future. And I would say, to me, I think that's a pretty unique opportunity because inflation expectations are nowhere near as high as actual inflation. So I think it's a good time to look for diversifying strategies and make sure that you have a well diversified portfolio because we just don't know what the future is going to hold.
Yeah, makes perfect sense. All right, so look at that, Nancy.
Hey, Rob, I do
I
have a question. Can you hear
Yeah,
me?
go ahead, Jeff. Go ahead.
Yeah, Rob, nice meeting you at Hedgeye
Yeah,
Live. And
absolutely. I was
Nancy,
just
I appreciate you tuning in to the weekly calls. And I have owned IVOL in the past. Actually, I still do. Um, my question is, I just want to go with a simple question because I think your experience is so deep that we sometimes avoid the simple question. We want to talk volatility and these swaptions and things. Frankly, I don't think I understand all that well, but I just kind of want to know your thoughts on the 10-year and maybe the significance of something Keith's talking about recently, which is the current cycle high is above the 2018 high. Or do you think we've broken a 40-year trend? And even I keep thinking that at some point, these longer bonds start to trade on the slower growth as opposed to the inflation, but I've been wrong on that. So I wanted your thoughts.
Yeah, it's I think it's I definitely think Keith is better equipped to be, kind of understanding the trends on something like the 10-year than me. I do think the 10-year yield does not make a lot of sense to me relative to the 2-year yield because it's inverted. So, just to look at the 2-year swap rate right now is 361 basis points. The 10-year treasury is 327 basis points. So just think about that. Like I think of it as like a tax. You actually are paying a tax to own 10-year bonds. You get paid less money to have more duration risk. So personally, with inflation incredibly high, and inflation protected strategies very low, like the 10-year break even is 2.6, meaning that's what they expect CPI to be, 2.6 to break even. I personally don't think, uh, you know, I don't know whether yields are going to go higher or lower, but I would say I think it's not, you're basically paying a premium to take more risk. So it's more risk and less return. So I'm again, I'm not, going to say, my strategies are not, the options piece at least are interest rate level agnostic. So we are accessing the spread between interest rates, not the absolute level of interest rates, which is why I think it's so nice because you don't have to take a bet about where interest rates end up being. You just have to say, I don't think they're going to be the same, which is, currently the yield curves are very, very inverted. But yeah, it's hard to justify owning, the 10-year treasury at that level, because you're locking in a very, very negative real return, and you're actually paying, I'd say a huge premium to own a more risky bond.
And I'll just throw out one more question if I could. So when you talk about too few investors have inflation protection in a bond portfolio, what type of inflation protection would you prefer? I mean, maybe I'm giving you a chance to just pitch your own book, but just in general, how should the bond side of your portfolio be positioned for inflation, I guess? So it's kind of a higher level question, but I think it'd be good to hear some basic. Thanks.
Yeah, no, it's a good question. I think there are two issues that I see. Number one is a lot of the passive indexes, and a lot of even the active managers are benchmarked to passive indexes. They don't have inflation protection in them. So there's, it's only short vol. There's no inflation protection in the ag. So generally people think they have core fixed income and they're diversified, but it's not really diversified because of the index composition. These indices are just really old, and the Treasury didn't even invent the inflation protected bond market until 1997. So I think that's another problem with everybody looks to the 70s, what happened in the 70s and what worked in an inflationary environment, but the rates markets were not developed in the 70s. So there were no inflation protected bonds to look at. Number one, they didn't exist. There was no interest rate derivatives markets. It didn't exist. So a lot of people look at, I'd say commodities, specifically oil and gold, or real estate or equities, because that's what worked in the 70s. But I think it's important to remember that these other products and instruments didn't exist in the 70s. So it's always important to say, back testing is very limited in my opinion, because it only, it's only looking at the instruments that were available then. And also back testing is history, right? It doesn't mean, anything for what's going to happen in the future. So I just think generally you don't want to be, I think a lot of people are using oil and gold and other commodities or real estate as inflation hedges. And I'm just not sure if they're going to work, especially if we have, more of a stagflationary environment where at some point, people will stop using as much. Like if we had a more stagflationary environment, I would expect oil to go down just from the demand side. And it's also pretty expensive. I get a lot of flack about, like, also with gold. Like, I don't really think gold is an inflation hedge. I think gold is its own beta. I'm not quite sure what that beta is, but it's definitely a currency bet. Especially you can use gold versus various currencies like, the Swiss franc or the euro or the dollar. And I think it's a psychology trade because it's clearly places people go for fear, but I don't think it's a great inflation hedge, personally. But it's only the only thing that really existed back in the 70s during the last period of inflation was those asset classes. And so I think that's why a lot of people look at them and say, oh yeah, this is what you should do in inflation. But you know, even the inflation protected bond market didn't exist until the late 90s. That's when the Treasury started it. So just be diversified. It's, again, I'm not trying to give financial advice, but I just think you have to be thoughtful with portfolio composition and just understanding, how all the different pieces work together.
Yeah, great questions, Jeff. Thank you very much. X2, you're up, buddy, and then Cincinnati, maybe I'll come to you. But yeah, Jeff, or X2, I don't know if you heard, but she can't really talk about any future ETFs. But if you got anything else,
no problem. I actually had another question. Nancy,
yeah,
thanks so much
by all
for
means.
taking the time. One of the questions that we've internally talked about several times is the credit risk, the counterparty risk, really, on these swaps that the ETFs are using. What we were asking it with regards to the inverse ETFs, because a lot of them use some of the dealers that could potentially have trouble and have had trouble in the past. Not to I have no idea what their current status are, but some of the smaller tier shops like SocGen or UBS or those types of guys, BNP. What are your thoughts on those concerns? Thanks.
Yeah, no, they have counterparty risk, and I'd also say more importantly, they have funding risk. Where, especially with a linear derivative like a swap, which a lot of the levered ETFs use, total return swaps. The requirements from the counterparty in terms of cash can change at any point. The same with the listed option. If you have a future, for instance, just to keep it simple, your margin requirement can change at any time. And so I think that's the big problem with linear derivatives, is that you don't really know uh, the funding obligation for the funds themselves, how much cash you have to put up, and so it creates funding risk. And that's why personally I'm not a huge fan of linear derivatives, because I don't like having that unknown, whether it's an exchange or whether it's a counterparty. At any point you could be asked for essentially more money, and to raise more money you have to sell uh what the fund invests in to raise that cash. So again, I'm not a big fan of linear derivatives. They're used all over the place, especially in fixed income, 40 Act funds, whether it's mutual funds or ETFs. But just be careful and be aware of the risks. And you know, all markets have, that are using linear derivatives have that funding risk component.
Okay, thanks so much.
Cincinnati or Cincy private funds. Did you have any questions for Nancy? And
yes,
welcome.
Thank you for taking my question, and thank you for doing
Absolutely.
this, Nancy. Our firm owns a portfolio of real estate whole loans, and I just have to say IVOL has been a tremendous benefit recently as an access product, allowing us to hedge some of our short convexity and interest rate risk in what we currently own in recent times. And we really appreciate you bringing that to market. We had been looking for a solution like that before even IVOL existed. And until IVOL and some other recent ETFs came to market, we just didn't have the ability, without an ISDA to hedge some of those risks that we were very aware of. So we really appreciate that. My question actually was along the lines of your other ETF, BNDD, and in the event that it becomes clear to the marketplace that we're headed for a recession, it's pretty inevitable, and that the Fed may pause or even reverse course. How do you expect the long options in BNDD to perform, contrasted with, say, an investment in long treasuries or in futures on long duration treasuries?
Well, first of all, thanks so much for your kind words. We really appreciate that at Quadratic. We've, it was, I think, really a solution, especially for accessing the interest rate markets and kind of trying to fix all the problems. Like tips, just, I don't think people realize like how limited they are, because very simply, the only index to reset inflation within treasury inflation protected securities, which is tips, is CPI, which a third of it is rent. So it's been kind of a career long passion to try to give investors another way to measure inflation expectations outside of just CPI, and actually fix the issues with tips being long duration as well. One thing I would say about BNDD is it's had a tremendous amount of outperformance since it listed versus the long dated treasuries that it owns. Obviously, bonds everywhere have been rocked, so owning duration has been a challenging thing. That strategy, I would say, is, it's more risky because the options and the bonds tend to work in the same direction, whereas IVOL, obviously all investing involves risk, but IVOL can have the bonds work when the options don't work, or the vol work when so it's not the same way, which is and I think the thing about whether we have a recession or not, I think it really depends on also the Fed. And IVOL can really it can benefit from either higher 10-year yields. So that would be more of an inflationary, stagflationary environment where foreign investors demand more yield to take on US debt. But it also can benefit from lower front dated yields. And that's with the Fed hikes. So personally, I think if we do have, if we're coming into the end of the year and it does look like we have more negative GDP prints, or even just going into the election year, I think the Fed could pivot away from using the balance sheet more instead of hiking rates to slow inflation. And that could potentially benefit IVOL by having less Fed hikes. Because remember, it's all what's priced in, and we have 189 basis points of additional hikes. That's not counting the 150 that's actually happened. So it's hard to know for sure exactly what's going to happen, whether investors are going to go run and buy duration, which would benefit, BNDD. IVOL has duration too from the treasuries that we own, but they're inflation protected treasuries, so it's real yields. Real yields have actually moved. They were negative before. Now they're actually positive. So I think it's more attractive to own um, lower real yields because they're quite positive now. I see the 10-year is about positive 65 right now. But I think it depends. I mean, I think generally, if investors were, you know, a lot of investors have to own duration, right? They're asset liability managers. They just have to have some kind of treasury duration. BNDD doesn't use linear derivatives. It uses that bond convexity. So it's just a different way of accessing the market. But my personal view is that I think IVOL is more attractive because I think inflation expectations are very low compared to realized inflation, and the yield curve is very negative. For instance, the 6-month twos tens curve is negative 37. So they're not called options, but you can think of them as, like call options inside of IVOL on that spread, which is negative. So I think it's a pretty attractive um, level. And I think it's neat because it doesn't matter if long dated yields go higher or short dated yields go lower, at least for the options component. It's kind of like either way and that happens in different environments. So we did, we have a financial professionals white paper on our website, which I need to update it. It's one of my to-dos that I keep procrastinating on because the numbers are a little old since we've had so many. This year's been a little busy in the rates market, but the concept.
I think we can all give you a pass on that one, Nancy.
I know. So
we understand.
the kind of way we tried to bucket it out was being very symmetric with risks as well as rewards in that paper, and talking about how IVOL could potentially work in a equity risk off environment when you have less Fed hikes or higher volatility, which is how we made money in the strategy in March 2020. Even though the tips that we own, which was about 85% of the portfolio, tips were down about 150 to 175 basis points using the passive index we use. But we had positive performance during that period because the Fed, you know, went from, actually cut rates and vol went higher. So it's kind of neat because you sort of have the risk off possibility. It could be potentially, obviously we didn't have the rate derivative markets during the 70s when we had stagflation, but I think that's something that would work in a stagflationary environment potentially, and then also in inflationary environments. I just don't think tips alone are going to work well because it's only CPI, and tips are also long duration. So even a short duration tip is still long duration. So that's we're trying to solve the problem with actually giving investors a way to profit from investors wanting more yield to own US dollar denominated debt.
Yeah, just on that comment. Sorry, Cincinnati. Just on that comment on the kind of 6 month out yield curve, like the tens and twos. I believe you said was minus 37. So, I pulled up your holdings this morning, and most of your it looks like most of the options that you kind of leverage are on that twos and tens spread. So what again? This may be a stupid question, Nancy, but so when the yield curve's kind of like inverted like that, are you just getting, like, simplistically, are you just getting better pricing for what kind of in terms of on a back tested basis in terms of just the yield curve obviously isn't usually inverted, and therefore your options pricing right now, is it just better pricing that you're getting for like 6 to 12 to 24 to 36 months out type thing?
I wouldn't say it's necessarily better pricing. It's just low
Okay.
levels to
Okay.
own. So they're not called what's inside eyeball. They're not called call options, but you could think of them as kind of like,
Okay.
it's different terminology for the rates market, but they're kind of call options on the yield curve. So when the yield curve's negative, and there's a lot of asymmetry there because it's not a normal environment, right? Normally investors, a simple example is if you go to a bank and you lock up your money in a CD, if you put your money in the bank longer, you would expect to get paid a little bit more, right? To
Yeah.
lock
Yeah.
your
Yeah.
capital. Right now, you
Yeah.
actually are paying, it's like a tax. You're actually paid less to own, longer, a more risky, longer duration bond. So it's really, you know, kind of a very wacky environment to have a negative curve, which is what it is right now. And at least going back over history, like the curve can stay, um, it's not saying it can't go more negative or it can't stay negative for a while, but I think the asymmetry is highly attractive because you're buying it at literally below zero levels.
Yep. That makes perfect sense. And probably a good way to finish up, unless Cincinnati, do you have any kind of follow up, or did that all make sense to you?
No, that was great. I really
Awesome.
appreciate your insight into how IVOL might perform well in even changing environments from what we're anticipating right now.
Yeah, very well said. And Nancy, just wanted to thank you again for being generous with your time this morning. We certainly greatly appreciate it, and your brilliant mind, and one that knows a heck of a lot about this market and this space. And so, again, we're just typically very in awe of all of your knowledge, Nancy. So thank you very, very much. And we greatly appreciate it. The replay will be available. I'll also send you that link, Nancy, just so that you have it. I'll put it up on YouTube as well, just if you do wish to post it anywhere. But that's again, thank you very much for your time.
Awesome. Well, thanks so much for having
Yeah.
me. I really enjoyed being a guest. And if anyone has any follow-up questions, feel free to reach out. And it's definitely a challenging time for a lot of investors, and so it's nice to be doing something that we feel is innovative in the space. There's a lot of strategies that look very similar to each other, so it takes a little bit more time to get more familiar with sort of differentiated strategies. But I think it's a good time to be doing something different than other
Yeah,
people.
to have a little bit of an open mind of what's in the portfolio, right, Nancy? Yeah.
Yeah.
No, that makes perfect sense, and thank you again, and just a little plug on my side. If you do like kind of most spaces and content, I have been able to create kind of an opportunity to sort of support some of that content. So thank you. I humbly thank you for that support, and Nancy, you're an absolute rock star. So thank you again for coming on, and we will certainly talk soon. I know we will. You have a knack for jumping on the Wednesday night calls and just sort of listening in, and then once we start to talk options and derivatives, it's hard to contain your excitement. So
Well, I do, like, I always tell, I do a lot of like volunteering for students and guest lecturing and stuff at various financial engineering schools, as well as some undergrad. I've even done it for high schools occasionally. But I think whatever you do, you want to love it. And I truly love this stuff. Like,
Mhm.
it's gets me fired up and excited. And it's all about education too, and trying to help people and help them. These markets are complicated, so it's important to just try to be very focused on educating investors, especially in a challenging time like right now. So I joined Twitter May 6th, so I'm pretty new to the community still, but I really enjoyed it. It's fun, and fun engaging, and joining these spaces. So thank you for
Yeah.
hosting this, and for the opportunity.
Yeah, 100%. And you hit the nail on the head there about education. It's certainly a passion of mine, and I know it's a passion of yours. So again, thank you very much. We'll wrap up, and we'll have our usual Wednesday night call tomorrow evening. It'll be an 8:31 on the East Coast, so 8:30 East Coast time, and see everyone there. Thank you again.
Thank you.
Have a great day, Nancy.
Thanks, you too. Thanks, everyone.
Cheers.
Bye.